Welcome to our discussion on savings plans and investments. Now that we've learned all about compound interest and how it can be a great thing or an evil thing, let's look at the examples where it's a great thing, where we're actually saving. And when we're doing saving plans and annuities and things like that, compound interest is our best friend. Here's our first formula. And this tells us how much money we're going to have, right? A is the accumulated savings or the amount that's left in our account after a certain amount of time. In this case, PMT for payment, instead of just being one initial lump sum payment that we used in our compound interest formulas in another video, this payment represents regular payments. These are sometimes called annuities. And it's a savings plan idea where you're going to deposit a set amount every X number of days into this savings plan. So maybe every month you're going to put $20 into it, or every week you're going to put $5 into it, or whatever it happens to be. You're going to have a schedule where a certain amount of money is placed into this account on a regular basis for then a certain amount of time, Y being the years. And you're going to get interest on that. And obviously, the more money you put into it and the more frequently you put into it, the interest is going to accumulate faster. Because if you took, let's say, $1,200 and you plunk that all down into your account at the end of the year, well, it didn't get any interest at all during the year. If you plunk it all down in the beginning, then it gets interest for the entire time. Well, you can't afford $1,200 right off the bat, but you can afford $100 a month. So you put $100 a month in it. So for the first, 29 days, you don't have anything, but then you put $100 in at the end of the month, you start getting interest on that $100. And then you get interest on that $100 for a month until the next $100 is placed in there. Okay, well now think of it this way. Instead of waiting that month to put in the $100, put $25 in each week. So now that first 30 days, instead of having nothing, you only have nothing for the first 6 days. And then after 7 days, bam, $25. And now you start getting interest on $25. Now sure, $25 is not $100, but at least you're getting, and then at the end of that week, $50, and then 75, and then 100. So you can see that the more frequently you put money in, even if you end up putting the same amount at the end of the year, you're putting smaller amounts in more frequently, you'll make more money. Not a lot more, but enough, and every little bit helps. So the first piece of advice is if you're going to do one of these, set it up with the most frequent payment plan you can. Most places will only let you pay monthly or sometimes weekly. If you can get it down to weekly, do weekly, and just have $5 taken out of your paycheck every week type of thing, or whatever you can afford, and it'll grow really fast. Okay, everything else is the same. APR is still, what we always have, and it's always still written as a decimal, and is still the number of payment periods per year. So if you're doing this thing monthly, N is 12. If you're doing it weekly, it's 52. If you're doing it daily, it's 365. You get the idea. And then Y is still number of years. All right, so none of that has changed. Here's a simple example. What's your balance after 6 months if you have an APR of 12% and you're doing monthly payments of 100? So our payment is 100, our APR is 0.12, we're doing it monthly, so N is 12. Because we're only doing it for 6 months, Y is 1/2, right, or 0.5. Simplify all that stuff as much as you can. Take the 0.12, divide it by 12, then add that to 1, take the 12, multiply it by 1/2, do all that kind of stuff. Simplify it down, do your power, do your subtraction, do your division, multiply, right? And then you get $615.20. Well, if you think about it this way, you put $100 in a month for 6 months. So you plunk down $600. The $15.20 is the interest you made. Here are some definitions. Like I said, an annuity is what we normally call these things where you have a regular payments into some account, right? You have equal regular payments, the same amount every blank days, 7, 12, 15, 30, whatever it is. An ordinary annuity is just a special kind of annuity. It's a special kind of savings plan in which you make your payments at the end of each month. So it's basically a special name they gave to an annuity where you're making your payments at the end of each month because it's kind of the most popular or most common annuity. An annuity due is where the payments are made at the beginning of each period. So again, who cares? Definitions. Future value is just how much money you have accumulated at the end, kind of the A, right, in our formula. And then the present value of a savings plan is a lump sum deposit that would be the same end result as regular payments into the plan. So your present value of a savings plan is not your payment, because your payment is how much you're putting in. The future value is how much you have at the end. That's your A, right? In the formula, that's A. Present value is the idea that instead of doing this whole annuity thing where I have to put a certain amount of money into this account every month for, 6 years or whatever, every week for 6 years, the present value of the savings plan is kind of the theoretical amount of money you would have to just plunk down into a savings account that's getting the same amount of interest for the same amount of time. So if you were going to put, well, let's look at this example up here. We put $100 into this account for 6 months, right? And at the end, we got 615 and 20 cents. And this was with an APR of 12%. Now, based on an APR of 12%, how much money would we have to actually plunk down into this account so that at the end of 6 months, we would have that same amount of money? We can actually do the math and we can figure that out. And that's what's called the present value of this annuity. So let's look at that math really quick so you see what we mean by this whole present value. Okay, this is how much money we need to have at the end of 6 months. So we would set that equal to some principal. We don't know what that principal is, but then we would use the normal compound interest formula, right, which is 1 plus our APR is still 12%, right? We're still doing monthly interest, right? And then we raise that to the 12 times 1/2, because again, we're still doing it for 6 months. And then we have to solve for P. So we get that it equals P times 1.01 to the 6th, right? It's pretty much, if you don't remember, it's up here, right? It becomes 1.0 to the 6th. And then to solve for P, we would divide both sides by it. So you end up getting this divided by 1.01 to the 6th, which ends up being, and you can double check this in your own calculators, 579 rounded to the nearest penny and 55 cents. So that means the present value of this annuity is $579.55, which means we would have to have $579.55 in our pockets, go plunk it down into a savings account earning 12% compounded monthly for 6 months. And at the end of the 6 months, we would have the same $615.20 that we got by instead taking $100 and plunking it into the account every month for 6 months. Okay, so that's the idea of a present value. It's kind of telling you how much money you would need now in the present in order to get the same amount out at the end. Here's another example of how these things work. You want to retire in 25 years, and when you retire, you want to be able to take out $50,000 per year forever. And you can do that if your money is in some sort of an investment that's making a constant amount of money, right? It's making a constant interest rate. So let's assume that you're getting a constant APR of 7% on, whatever this investment thing is for your retirement. So if you want to have $50,000 in interest every year, then we need to figure out 7% of what equals 50%. Right? 7% of some amount equals 50,000. Well, this right here, right, is just 0.07. So we divide both sides by 0.07. That's where this comes from. And we get this amount. Well, you round up a little bit, right, because you want to have 50,000. You don't want to be shorted. So we just basically say we need about $715,000 when we retire. That means that in 25 years, we better have $715,000 in this account in order to be able to pull out $50,000 a year and then be able to keep doing that. Because you want to be able to pull $50,000 out and then your interest covers it, right? You make enough interest at the end of the year, you now have 765,000. You pull out that 50, and then at the end of the year, it's back up to 765. You pull out that 50. You get the idea. Okay, so let's assume you want to try and accumulate this $715,000 by making regular monthly payments into some sort of savings plan. We're going to have that same APR of 7%. It's monthly payments, so our N is 12, and we want to retire in 25 years, so that's our Y. If we go to our formula and plug everything in and basically do a little simple algebra and solve for payment. So if you take this formula and you want to get payment all by itself, right? Because we need to know how much we have to plug in. So we're trying to solve for this. Well, payment times all of this equals A. So all you have to do is multiply by the reciprocal, right? You're basically flipping it. So this goes up top, right? And this comes down there. You flip it. So it's A times all of that stuff, which is what we have right here. All right. This was the piece that was underneath it, right? That was the bottom, and it's been flipped. So if we can do this, we can figure out how much we have to do to, how much we have to put in each year, or sorry, each month to get this money. You plug in all the numbers, you do the math, and it tells you that you need to invest basically $883 per month for the next 25 years. That's a lot of money, but that's what you'd have to do if you wanted to retire in that fashion. Now, some of you might be confused as to why it's A plus APR over N. That's a typo on my slide. These should be multiplication here and here. You can see that I caught it here, but this should be multiply, right? Because obviously if we flip and multiply, we're flipping and multiplying. We're not flipping and adding, okay? So that's how we get down here, and that's how you'd be able to retire. Okay, total return is the percentage change in the investment value. So let's say you put some money into some kind of investment. It doesn't matter if it's an annuity or bonds or stocks or whatever it happens to be. You start with some principal P, and it later becomes your accumulated balance A, or you can think of as your amount. The total return is just percent change. Remember, percent change is actual change between two things divided by your starting amount, and your starting amount was your principal P. So here's your difference between the two, right? How much you have now minus how much you started with, that's your difference, divided by your starting amount, and then you multiply that by 100 to get, to turn it into a percentage. The annual return, so let's say you have an investment that goes from P to A in just Y years. Then the annual return, so Y can be anything. It doesn't have to be 1 year, it could be 5 years, 10 years. The annual return is the annual percentage yield, the APY, that would give you the same overall growth. So it's back to that idea that, remember when we had APR and APY, we said APY was the actual percent yield that you got after a year. If you were compounding every month or every day or whatever it happened to be, at the end of 1 year, you actually got more percent than if you just compounded once per year. And APY was what that percentage was. Well, this is the same idea, but it's the idea in terms of how much return you make on your money. So it's basically just saying if you put something into an account and you were making 7% a year and it was compounding monthly and you did it for 10 years, well, each year you're going to be getting more and more money because it's growing, right? That the first year's interest then affects the second year's interest and so on and so on and so forth. And you get to that final end point after 10 years and you have your A. Well, you take that A, you subtract your P from it, and that's how much you got total over that 10-year period. Well, the annual return is kind of the annual percentage yield that you would have to have that would give you that same overall 10-year growth. And it's kind of an ugly formula. I'm not going to spend any time going through it. Just slap it in your notes as another formula to use. So here's your ratio of A to P, 1 over Y minus 1, and that gives you your annual return. Here's an example. You put 3,000 into a mutual fund for 4 years. Your investment grows to 8,400. What are your total and annual returns for the 4-year period? Well, total return is really easy. That's that percent increase, and that's just the difference divided by where you started, right? So percent change times 100%. Your 8,400 is what it's at now. 3,000 is where it started, right? Dividing by the starting point, blah, 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 and 180%. So that basically means that your investment, right, went up by 180%. This is an increase. It's not your new investment is not 180% of what it used to be, because 180% is less than 2 times, and you can see that 8,400 is more than 2 times 3,000, right? But the difference between the two, right? When you take 8,400 and minus 3,000 from it, you get 5,400, which is just a little bit less than twice as much, right? Because twice as much would be 6,000. So this is a difference. It went up by 180%. If you want to know, what it is now, well, it is 280% of what it used to be, right? If you wanted to get 8,400 from 3,000, you would have to multiply by 2.8, 280%. But it's gone up. Its total return is that difference, how much it's grown, and it's grown by 180%, which is pretty darn good. We would all hope to get that kind of return. The annual return is just the ratio of the two numbers, and then raised to a power, subtract the 1, do the math, you get 29.4%. So that basically means over that 4-year period, it went up, right, or it grew by 29.4% per year. So if you took your 3,000 and gave yourself 29.4% interest at the end of year 1, and then at the end of year 2, did 29.4% of that new amount, remember, because this is compounding, and kept doing that, at the end of 4 years, you would have that 8,400. All right, let's talk briefly, because I'm not a financial expert. I'm just going to go through some of these terms because you're going to see them in different classes of types of investments, right? Stocks or equity is where you buy a certain amount of ownership in company. Companies that go public, right, are selling shares of their company, and it's basically saying we're now going to let you be, excuse me, a limited owner of this particular company. It usually means nothing other than you share in the profits or losses of the company. It's not like you all of a sudden get a vote. Sometimes you do. You can be called a voting member, where you have voting rights, and then sometimes you're just a member, right? So if you buy stock, the only way to get your money out normally is to sell the stock. You buy it at a certain price, hopefully it goes up, you sell it and you get a profit. So sometimes it can go down and you can lose money. You can also get more money if the stock splits or you're somehow given more shares, right? But the only time you ever get your actual liquid money out is to sell the things. And a lot of times that's what they talk about for liquid investments versus non-liquid investments. Okay, a bond is kind of like a debt, and it represents a promise of future cash. You normally buy a bond by paying some principal amount to an issuing body. It's normally a large corporation, and more often than not, it's a government, usually the U.S. government. So you'll buy a U.S. savings bond is a very typical type of bond. The issuer, the person, in this case, the U.S. government, pays you simple interest as opposed to compound interest. They just pay you a set amount every month or every year, whatever it happens to be figured out, for kind of the privilege of having your money. It's kind of like a loan, right? You give them money, they give you interest, and then they also promise to pay back your initial investment plus interest at some later date, right? So you can buy like a 10-year bond or a 20-year bond or a 30-year bond, and you get interest for all that time, and then you get a payout later. It's a very safe investment because it's guaranteed by these big companies and these big governments, but it's also a very low paying investment. It's usually very low interest rates, and so it doesn't pay off with a lot of money. Whereas stocks, you can make a fortune, but you can also lose a fortune. They're very volatile and they're very risky, but they have a high potential for big profits. Cash investments Um, it's your idea of you go to a bank and you buy a CD, certificates of deposit, or you buy U.S. Treasury bills, or you just slap some money down into a savings account and you get certain interest rate on those. Those are also very safe, but they're also very low on interest rates. You don't make a lot of money on these types of things. So a good investment portfolio is usually a mixture of different types of things. And they talk about, depending on how old you are and how much risk you want to take as to how much money you put into each type of thing. And this is where we talk about liquidity, risk, and return. You guys can pause and read all about that. Stock market trends, you know all about hopefully the stock market. And if you don't, definitely read up before you invest, right? In general, there's only two ways to make money on stocks. Either the stock goes up and you sell it, and then you get what's called a capital gain because you bought it for X number of dollars, you sold it for it's now more, so you're making money on each share that you sell. Or while you're owning the stock, the company that that you basically have a partner or a piece of, they might distribute part or all of their profits to stockholders as dividends. The company made a lot of money this year, and so every stockholder is going to get this extra. It's kind of like a bonus check type of thing. And then also the stocks can split, which means, our company has gotten so awesome and we don't want to raise the stock price. So instead of raising the stock price, we're just going to double all of the shares. So if you owned $100, or sorry, 100 shares, you now own 200 shares. And then they sometimes also back the price off a little bit. So you didn't actually double your money, but it would go up by usually a substantial amount. Okay, this slide is asking you to kind of read this and answer a bunch of questions. If you want to figure out what stock quotes look like in a paper, by all means, pause the video, take a look at this slide, and then see if you can answer these questions. I'm not going to spend a lot of time on it. You can do this on your own, right? The following, here are the solutions as to the answers. What is the symbol and what are all the different things mean and how much money does it make? It can be very confusing. So if you really want to understand stocks, take some time, pause the video, look at that printout, and then read these things. And then I suggest maybe going to YouTube or getting one of those, Stocks for Dummies books or something like that, because it can be very confusing. There's a lot of numbers they throw at you. Bonds, we talked about those a little bit. Again, here's some more vocabulary for bonds. Here's an example of figuring out current yield and annual interest on a bond. Mutual funds, another investment type of investments. Nice thing about mutual funds is some of them can be what are called tax exempt. You can put money into them pre-tax, which means you have your certain salary, you take money out of your salary and put it into your what's normally called like an IRA before you get taxed, and then you don't get taxed on that money. It's as if you didn't make that money. And then at the end, depending on how you take it out, if you wait till retirement age and stuff like that, you can actually avoid ever paying taxes at all on that money. It's kind of a nice thing. It's a great way to save for the future. Here are quotes for mutual funds, just like stocks. And again, if you want to, you can pause and look at that, and based on that, you can figure out what some of that stuff means. And that is the end of our very long discussion on savings plans.